Here's a little bit about me. I'm an accredited financial counselor. I'm licensed from the Association of Counseling and Planning Education, the AFCPE, which is the leading licensing organization for financial counselors and coaches in the United States. I'm also a HerMoney coach for the last 3 years. I head up Jean Chatzky's FinanceFixx and InvestingFixx programs. And I just want to make a quick disclaimer that this presentation today is for educational purposes only. I am not an investment advisor, nor am I making any financial recommendations. How many of you consider yourselves to be investors? And Joe from HerMoney is going to post our A, B, and C choices in the chat. So A would be definitely yes. B, I'm not sure, but I think so. And C would be no, not yet. And I would love to know, where do you feel that you are on that? So if you contribute to the 401k plan at your company, but you never look at your account, do you think you're an investor? Or what about if you invest in index funds that are passively managed? Does that count? So that's kind of the stuff we're going to talk about today. So a lot of people think that this is investing, but this is more along the lines of trading, like Jim Cramer on CNBC. He buys and he sells much more frequently, betting that investments will fall in price as well as rise, but we call that short selling. But investing is slower and longer term. It's a process which you can and actually should be patient. It's a world in which everyone actually can get a trophy. And although traders and investors sometimes use complicated technical tools and analysis to tell them what to buy, sell, and when, investing doesn't have to be that complicated to set you up nicely for the future. So if you aren't sure what it means to be an investor, let me ask you, do you have money in a retirement plan? What about company stock? 529 plan for your college savings account? Or a brokerage firm or a robo-advisor? Or have you ever seen those apps like Acorn on the phone where you save spare change? That all counts. So whether you look at it once a week or once a year, like I said, it all counts, it all matters, you're an investor. So in order to invest your money properly, you have to know what you're investing your money for. So that means asking ourselves, what do we want from our money? Overall, most of us, particularly women, want safety and security. We want to increase the time and freedom we have to pursue the things we want to do and offload those that we don't. We want to have choices when it comes to our careers, education, and community. We want control. We want to pay it forward and we want nice stuff. And there's nothing wrong with wanting nice stuff. But we also have to understand what we want in a more specific sense, meaning our short-term, medium-term, and long-term goals. Short, anything under 3 years, medium, 3 to 5 years, and longer-term, 5 and beyond. Why do we need to know this? Because knowing it, say you want to buy a house in 2 years and you need enough of a down payment, requires something totally different than if we don't need our money for 2 decades in retirement. And there's essentially 2 ways to get there. We can earn more and we can save more. And we can save even more by investing our money. So working is great, but we can't do it forever. In fact, one thing many people actually don't understand is that for about 2/3 of us, we might not have a choice on when we retire. This could be because of layoffs, health changes, caregiving challenges. It's a decision that's made for us. And so savings alone was fine in the 70s and 80s with interest rates at 18%. And it's a lot better than it was in the early years of this century when interest rates were at historic lows. But even at today's rates, saving in and of itself is not enough. High interest savings accounts are a good place to park your emergency savings funds, but that's pretty much just to keep on par with inflation. So to actually make money, we need to turn to investing. Investing is the way we stay ahead. And yet time and time again, I hear people say that they aren't doing it or they're not leaning into it as much as they would like. So here's some common thoughts that people have around getting better with investing. I thought I'd share them and see if any of them resonate with you. I've made financial mistakes in the past, and I'm fearful it will happen again. I'm pretty confident in my ability to earn money through my job, but not through investing. I'm afraid of losing my hard-earned money in the markets. I don't understand how it works, so I'm nervous I won't make good decisions. Or investing is the same as gambling. They're all understandable fears, but there's one thing I want you to understand. Like so many of us, so many things in the world of money, investing isn't rocket science. It's actually good habits often repeated. And I'm going to show you how. So there's 3 things that determine how successful most investors are. Number 1 is the amount you save. Number 2 is your asset allocation, or that mix of investments. So we have stocks, the riskiest, bonds, a little less risky, and cash, safe except for inflation and taxes. And you choose to balance the risk reward. And the third thing is the security selection. So the particular stocks, bonds, and funds that you put in those asset buckets. Now, number 1 is the most important. Just like you can't out-exercise a bad diet, you can't invest your way out of a savings shortfall. So if you don't have enough, you don't have enough of a base for it to grow. So savings is first and non-negotiable. Number 2 is a close second. In fact, research has shown that asset allocation, that mix of stocks and bonds and other things, is responsible for about 90% of the return on your money. Number 3, you hardly have to think about it all. You can do all of this by just buying the markets overall, which I'll explain in a minute. In fact, I'm not even going to go into how to pick a stock or a bond. If that's something you want to learn, and I'm talking to all the women out there, we have our InvestingFixx club that Jean Chatsky and Karen Feinerman from CNBC run every other Monday night. I'm the coach of that club, and it's an amazing group of women. Karen and Jean are teaching us all about the ins and outs of picking stocks and investments. We're building a portfolio together, and right now we're actually beating the market. So if you want to try it out, please come and try it out. So how much do you need to save for the long term? So Jean always says a solid 15% of whatever you're earning over the course of your career, if you start young enough, should get you to the point where you can retire knowing that you're able to replace about 85% of your pre-retirement income. And the assumption is that we shouldn't need our full income in retirement. It should be a little bit less expensive as we go to retire. So, and that 85% is investing, saving, and Social Security income in that number. And that will last you about 30 years. So as I said, that 15% includes matching dollars from your employer, as well as any contributions you make into 401ks, other work-based plans, any kind of IRAs or Roth IRAs, retirement accounts you have for being self-employed, all of that. If you're maxing out those tax-advantaged retirement accounts and you can still do more, then you could put some of your money into a taxable brokerage account. So how do we know if we're on track? Here's some benchmarks. They were developed by Fidelity Investments. Many financial experts and firms use similar guidelines. What I like about them is it's kind of an easy way to digest where you should be. But right now you might be having one of 2 reactions. You're either nodding along, I'm on track, or you're ready to spit out your drink and go join another webinar. So please don't fret. I don't want you to panic. We want to get you to that 15% mark though. So how can we do that? We can start bumping up our percentage every 6 months. There's some employers actually that automatically bump up your 401k without you even knowing it. And you have to let them know that you don't want to be bumped up. So that little bump up really helps because it gets us started. And then every raise or bonus, we can see if we can do a little bit more. So if you're having trouble saving, first thing is I just did a retirement readiness webinar for Town and Country. So if you're able to go check that out, that was great. And that had a lot of kind of tips and ways to get on track. You can also sign up. We have in one other class, we have FinanceFixx, our 8-week class. We dive into tracking our spending, setting some not spend goals, and just building better money habits for kind of seeing our money clearly. So if that's of interest, check that out. So number 1 was the amount you save. Number 2 is your asset allocation. So there's a lot of research on the importance of asset allocation and how it compares to the importance of security selection, which is that picking of the individual stocks or bonds. It actually could make your whole head spin. So let's break down what you really need to know. In 1986, 3 researchers did a deep dive on the performance of pension plans, which are broad pools of retirement assets, and determined that asset allocation was responsible for about 94% of the performance. In other words, it wasn't about the individual investments. So it was about the mix. The paper they published is still cited to this day, and there's been follow-up studies. Some of them say it counts for 80%, others say 100%, others a little less, but in any case, it's the lion's share. So we have an asset allocation guide. Actually, Jean crafted it with a financial advisor for her book, Women with Money, and we're going to download it, drop it in the chat for you guys. This breaks down your asset allocation guide by decade, if you're just looking for a little bit of a guide. As we age, the rule of thumb is to kind of take less risk, so that when we need the money, it doesn't derail our plans based on the market. So why do if we can, if we have this guide, so why do individual investors even bother picking stock picks? Because they want to win. I don't know if you have kids, I have kids, and they want to win. I actually told them they can't invest in the market until they start going to InvestingFixx and learning about the market, and then I'll let them start. But my son actually just got his first job, and he did set up a Roth IRA, so he could get started young. But if you've ever watched the financial news, you've heard them say the word benchmark. And a benchmark is the standard we use for comparison. So in the world of chocolate chip cookies, the benchmark might be Toll House cookie recipe. Here's actually a post I did on my Toll House cookies. It works pretty much because everyone knows what Toll House cookies are, what they taste like, what they look like. Was your recipe better, worse, or just as good as somebody else's? And ironically, like I happened to post this a few weeks ago, referencing how easy it is to bake Toll House cookie recipe. And in the world of investments, benchmarks are like that. They're indexes that have been created to represent big pieces of the overall market. The Dow Jones Industrial Average and the S&P 500 are 2 popular benchmarks. There are others for bonds and others for mutual funds. The whole point of security selection, or picking individual stocks, bonds, or mutual funds, is trying to beat those benchmarks. So what do you do if you don't care about that? Well, what if you decided the benchmarks are just fine? Actually, the Dow has gone up a little less than 8% annually since its inception, and the S&P 500, 10%. So if you are fine with that, you are giving yourself permission to be a boring investor. I'm actually a boring investor. Nothing wrong with it. Boring investors also benefit because buying indexes, whether you buy index funds or ETFs, which are exchange traded funds that trade like stocks, it's a lot less expensive than buying actively managed mutual funds. All of the money you save is money that goes to your bottom line. The other way you can do this is with a target date fund, and I'll explain that in a few minutes. So getting there means picking an asset allocation that works for you. One important thing, though, is once you set it, you need to give it time to do its work. Markets have bad days, bad weeks, bad months, and frequent trading leads to mistakes. You would need to worry about that. Who needs to, like, I wouldn't want to worry about that if you're not worried about when to get in and when to get out. Let's be boring investors together, because that adds a level of stress and prevents people from being in the market when they're watching too carefully. We're playing the long game though. So that asset allocation is the most important, along with building that savings amount. So if all of this is not enough to get you going, how can you feel comfortable? Well, as we like to say, just do it. Honestly, though, investing is one of those things that you can kind of fake it till you make it. And because if you do what we're outlining here, and we have 5 different options going from the easiest to the most involved, history shows that you should be successful, and that success breeds confidence. So we want to get everyone to be more confident investors. And there's an important message for women here, because women are still making 20 cents less on the dollar, and we tend to dip in and out of the workforce. So our 401k or retirement plan is a lot less, up to 50% less than some men. So investing can help us close that gap. So now let's go to the buckets. There's 3 basic buckets. We have taxable, tax deferred, and tax-free. So the taxable includes your regular bank, brokerage accounts. You generally pay taxes annually as you realize the interest. There's some investments that have preferred tax treatments, like municipal bonds, where you're incentivized. In the second bucket, we have tax deferred. Again, there's an incentive here. They want us to save, so they're letting us contribute our money before taxes and not pay the taxes until we take it out in retirement. And when can you start doing that? You can start taking that money out at 59.5, and you're required to take it out starting at 73. And then the last bucket we have is tax-free. So you've already paid the income on this taxes, but the money grows tax-free, and you get to take it out tax-free. So you may have heard of a Roth IRA. That would fall in this bucket, as well as an HSA, health savings account, and that's when you use it for health expenses. Always read the fine print. Make sure you understand what you're buying before you buy it. But those are the general 3 buckets that things fall into. One question that comes up a lot, and it came up in the pre-questions, were how do you decide between a traditional and a Roth IRA? And the rule of thumb there is if you think your tax bracket is higher now than it would be in retirement, it may make sense to do the traditional. But if you feel that your tax bracket is lower now, which it is for a lot of young people, or if you feel that the US tax rates might go up by a lot, a Roth might make sense. Roth also has flexibility in that you can pull your contributions if you need to, not what you earn on the money. You could pull your contributions without a penalty. Again, look at all the rules before going into all that stuff. And if you're self-employed, there's some other options like a SEP IRA, simple IRA, and solo 401k. Okay, so now that we've talked about the buckets, we're going to start filling them up. Okay, so let's talk about the filling. The filling we have from the easiest to the more involved. So the easiest is the do it for me, set it and forget it, target date fund. This is a fund designed to help you retire at a certain age. So that date is always referenced in the name of the fund, like the Vanguard Target Retirement 2050. It invests your money more aggressively at the beginning and then less aggressively as you start to age, and it auto adjusts for you. Many work-based plans auto enroll you in these type of assets. To make it easier, you would have to elect not to be in it. The one important thing with these target date funds is that it is assuming that all of your investments are in this one fund. If you are now investing in other things, it's going to throw your mix off. So it is really important that you'll do all the investing in this fund. And I've listed some average fees, which in investing terms are called the expense ratio. The next choice is a robo-advisor. I've put some of the companies you may have heard of up there. This is a computer-driven financial planning service. You answer a whole bunch of questions when you first get started. and the computer uses your answers to figure out an asset allocation. And then it keeps you in balance over time. Now, other big firms like Schwab, Fidelity, Vanguard are offering robo-advising services. Most cannot handle 401ks though, but you can open an IRA or a taxable brokerage account. Our next choice is a managed account through your workplace. So this is a way of bringing personal advice to 401ks and other work-based plans. You fill out a questionnaire about your goals, then either a robo-advisor or a service representative would help you make the appropriate choice of mix of your assets. You probably have a representative that's there to answer questions as well, and fees can range from free to 0.5%. That's just a guide. The next one, which most probably everyone's familiar with, is that financial advisor, the certified financial planner. This person is either independent or works within a brokerage firm that you hire to manage your investments and your goals. Some manage, it's called assets under management, and they will charge a percentage of your portfolio. There's others that will just charge a fee for financial planning consult services and not actually make your investments choices. So definitely figure out what you're looking for. We have some good guides on that and how to pick a financial planner and questions to ask and the different choices. The last choice is the do-it-yourself version. So this takes a little bit more work, and you do have to rebalance your portfolio once or twice a year to make sure you have that correct mix. This is the most labor-intensive solution, but it doesn't have to be difficult. So you open an account and then you regularly invest in a mix of assets that work for your age and your risk tolerance. You can find this mix with index funds that are run by computers that track a particular portion of the market. Where it would say buy a short-term bond, you would buy a short-term bond index fund. Index funds are both inexpensive and tax efficient. There's also ETFs. ETFs are traded like stocks. They would also work too. Active traders often prefer ETFs because they're a little cheaper. So how much does it cost to invest this way? It actually varies dramatically based on the cost of the investment. But if you choose index funds, it can be less than 0.2% annually. Fidelity has them that even cost zero. So the biggest takeaway is no matter which way you choose to fill your portfolio, you need to do this for your sanity and for your future security. Automate the transfers. This means setting up a system of making regular contributions into your account and your mix of assets so you don't have to think about it. Okay, when we are forced to constantly have to make decisions, it's easier for us to kind of derail our own plans. When it's just set and done, we are more likely to comply. So the magic of the 401k is actually that they do this via a paycheck deduction. And if you don't have a system for that, or you don't work with an employer that can do that for you, that's okay. You can set this up yourself, right? We can open an IRA, or there's other choices depending on your situation. And then once this part is done, then you just have to watch your money add up. So let's just knock down a few obstacles that you might be thinking. So I don't know if these things have ever gotten in your way. I don't know if some of you feel like you don't want to do something because you don't understand it. Well, I just taught 2 teenagers how to drive a car, and they definitely did not understand it when we got started. And my middle one is a year into driving, and while he is much better and confident, he will definitely still has a lot to learn, right? Like it could take a decade before he drives the way that more mature adults are driving. It takes time, but it's not stopping him from driving. And that's the message we want to get through, that even if you don't understand all of it, start with something, build on it. You'll get better at it. I'm not telling you to invest aggressively, but do your research. Now you have some options, figure it out as you go. And every step you open the brokerage account, now you know how to open a brokerage account. You invest your money in a mix of assets. Well, now you've done it. So now you Now it might be easier the second time. You've set up the automatic transfer. Oh, that wasn't that hard. I need to change bank accounts. No big deal. I'll go in and switch it. So we don't procrastinate because now we've done it. Now we know what we're doing. So investing is like that, these obstacles, and I just don't want that to get in your way. So as you go, you may even realize that you know more than you think you do. So let's go to obstacle 2. You don't want to lose money. Some people, particularly women, don't like that feeling of competition and feeling like people lose in the stock market. They don't like seeing people trying to get a leg up on other people. It just doesn't sit right. However, that competition is more along the lines of trading. Investing is not like that. Investing, you can win. And given sufficient time, no one really has to lose. History bears that, as you can see in this chart. If you invested your money in the S&P 500 over the worst 30-year period in history, you will have still made about 8% per year. But if you don't invest, you will lose because of taxes and inflation. Obstacle 3, when you're gambling, you're wagering your money on a particular outcome. If that outcome doesn't pan out, your lottery numbers aren't called, you lose it all. When you're investing, though, you're buying something, a piece of a company when you buy a stock, small pieces of many when you buy a mutual fund. And that something has value. So over time, that value can go up and down, but not buying just one stock, instead spreading your risk out over many, which we call diversification. And by investing over time, you're vastly increasing your chances of making money and not losing money. Obstacle 4, you don't trust the financial industry. So in a 2017 survey, the financial industry's trustworthiness ranked 3rd behind oil and petroleum. Yet we wouldn't let a lack of trust stop us from filling up our car with gas. So you don't have to trust the financial industry to take advantage of it. So you have to shop smart and find a single firm or individual that you want to work with. You have choices. So even when these obstacles are cleared, you might need a little push to get going. So I suggest finding your why. Why do you need your money to grow? Do you want to stop working? Do you want to put your kids through college? To give to more causes that you believe in? Making investing personal can help propel you to take those steps to take action. So I just wanted to conclude by telling you can find me. Feel free to email me at Rachael@HerMoney.com. Or find out more about us at HerMoney.com. Okay, so Channing, now I got your question. Options for the self-employed. That would be the SEP IRA, the solo IRA, solo 401k. I would talk to research those. They come with different fees and rules. So, and you could do the traditional or the Roth IRA as well. Those have income limits and some restrictions. So just take a look at those. So we want to get people saving for retirement. We want to get people thinking about their future. We know that there's a lot of demands on your next dollar. I know there was a question on how do I deal with paying back credit card debt and emergency fund and investing in all of this stuff, right? So we really want to get that investing number up to 15%, including the match, including any other things that come your way. But that's like really our goal. And if you started later, unfortunately, we need to bump that number up a little bit more. So getting to know your numbers clearly, getting clear on your budget, I find is really helpful. Do you know tracking your spending increase leads to spending 20% less? Just by us paying attention to where our money is going. I have helped so many people. And I say, download the last 30 to 45 days. I bet we're going to find at least one transaction that you didn't know you were charged for, or a subscription that you forgot to cancel, or something. And so you work really hard for your money. So let's make sure we know exactly where it's going. And so if you can't do 15% to start, a lot of young people, that would be hard for them. Start with what you can do. You know, if you're at an employer, taking that match is important. But the other factors, building that emergency fund and debt payback are considerations here. Because we're just talking about investing basics, we wanted to get to that 15% number, but I understand that there's competing priorities out there. HerMoney has an article on how to pick an investment advisor and what question to ask. There's Garrett Planning Network, I believe it's called, and there's Abundo Wealth. Those are two that are good. There's the XY Planning Network, which has certified financial planners, a list of people we recommend checking out that list. Of course, asking friends and family and colleagues for referrals and always vetting them. I find that our behaviors around money don't get talked about enough. And money in and of itself is just a math problem, but when our emotions and thoughts and feelings factor in, totally different story, right? And when we spend, we get an adrenaline rush. And so a lot of the coaching that we do, we talk about why we, not just like why are we spending, but can we build in that pause, and can we add things like deleting our credit cards from our online accounts and making ourselves go to the wallet and get the credit card to enter it, not buying something right away, seeing your money clearly, and then empowering yourself to make decisions. Do I really want that concert ticket and to go out to eat? And, you know, money is a limited resource. It's limited for all of us, but we don't want to feel like we're always restricted. We just want to have choices. And so when we can see our money clearly, we're given that space to have choices. And that investing and saving for our future, I feel like way back when we might have done that as a second, like at the bottom of our budget. Okay, this is what I earned, this is what I spent, this is a little bit that I have left over. And we're flipping that script, and we're taking our income and we're seeing, can we take that 15% off right off the top? Now, this is what we have to work with. And I know it's hard, and I know it doesn't happen overnight, but just getting yourselves to start and getting yourselves to bump up as you go. So InvestingFixx is good if you want to learn more about the economy, learn how to pick stocks and different investments, and kind of see the methodology that Karen Finerman uses. She's amazing. She's been doing this for years. She's on CNBC's Fast Money, and she teaches us how to research the different investment choices. We have a mock portfolio that you can kind of build as you go if you want to just dabble in that. Feel free to come try it out. We have free first month. So our group of women really like it. We have about 250 women in that group. Thanks for joining.